In 2026, a retired couple is bringing in about $80,000 a year in retirement income. When they file their taxes this spring, the IRS is going to count almost none of it. Not because they cheated and not because they found some obscure loophole buried in a tax shelter, it's simply because they know which types of retirement income the tax code doesn't touch. There are 7 of them. Most retirees know 1, maybe 2. The other 5 or 6 sit there completely legal and completely unused for an entire retirement. By the end of this video, you'll know all 7, including the last one, which almost nobody believes could possibly apply to them, but they're wrong. Hey, I'm Lana Maines. I'm here to give you the kind of financial information that actually helps you keep more of what you've earned in retirement, the stuff nobody sits you down to explain. So if that sounds useful, hit subscribe because that's exactly what this channel is built around. Let's start with the one you've probably already heard of because even that one has 2 layers almost nobody explains. Category 1 is the Roth account. Qualified distributions from a Roth IRA are not deferred income, and they are not income where you settle up later. They are simply not taxable income. The IRS has no legal claim on a qualified Roth distribution. That's the foundation. The part almost nobody explains is the 5-year rule. A Roth IRA distribution is only tax-free if the account has been open for at least 5 years and you are at least 59 and a half years old. If you converted a traditional IRA to a Roth a few years back, that conversion starts its own 5-year clock, separate from your original Roth. This quietly disqualifies tax-free treatment for people who converted late and then withdrew too soon. The distribution still comes out, but the tax bill comes right along with it. Break this down by where you're starting from. If you're a lower-income retiree drawing mostly from Social Security and a small IRA, a Roth conversion done carefully over several lower-income years can permanently move future growth out of the IRS's reach. If you're a retiree with a larger account balance, the 5-year rule becomes your planning constraint, not an obstacle, because you have time to stage conversions deliberately. One more piece matters just as much. There are no required minimum distributions, RMDs, from a Roth IRA during the owner's lifetime. At age 73, the IRS forces withdrawals from traditional IRAs and 401k, plans whether you need the money or not, and those forced withdrawals count as taxable income. A Roth account carries no such requirement. You control the timing entirely. And while we're on the subject of forced withdrawals, there's a related move worth knowing if you're 70 and a half or older and charitably inclined, a qualified charitable distribution, QCD. You can direct money straight from a traditional IRA to a qualified charity, and that transfer counts toward your required minimum distribution without ever showing up as taxable income on your return. It never touches your adjusted gross income, which means it never touches your Social Security calculation or your Medicare premiums either. Most retirees who give to charity write a check from their bank account after the RMD has already been taxed. Routing it directly from the IRA instead means that portion of the RMD is never taxed at all. One more note on the Roth strategy before we move on. If your income is too high to contribute to a Roth directly, there's a legal workaround called a backdoor Roth conversion. You contribute to a traditional non-deductible IRA first, then convert it to a Roth shortly after. Because the contribution was already made with after-tax dollars, the conversion itself typically triggers little to no additional tax. From that point forward, the money follows every Roth rule already covered. No RMDs, no impact on your Social Security calculation, and no impact on Medicare premiums. It's a few extra steps, but for a higher earner who is still working, it's often the only door into this category at all. It's also worth knowing that once you turn 65, the standard deduction itself gets a boost. Every filer 65 or older receives an additional standard deduction on top of the regular one, applied automatically when you file. No form, no election, nothing to track. It doesn't belong to any single category on this list, but it stacks with everything else here, quietly shrinking the amount of income that's taxable in the first place, regardless of which bucket that income came from. That leads into category 2, because it works the exact same way at the income level. just for a different type of asset. Municipal bond interest is excluded from federal gross income under the tax code. Not deferred, not deducted, not settled later, simply not counted as taxable income. In many states, if you buy bonds issued by your home state, the interest is also free from state income tax. Take the couple from the opening. If a portion of their $80,000 is routed through qualifying municipal bonds instead of a taxable bond fund or savings account, the interest those bonds generate never enters their taxable income calculation. It doesn't affect their Social Security threshold, and it doesn't affect their Medicare premium calculation. It's real money arriving in their account that simply isn't there for tax purposes. For a lower income retiree, municipal bonds may carry a lower nominal yield than taxable alternatives, but the after-tax comparison often still favors the muni, depending on your bracket. For someone in a higher bracket, the tax equivalent yield on munis frequently exceeds what taxable bonds pay out after the IRS takes its cut, and that gap widens the higher your ordinary income rate climbs. One honest caveat worth knowing: while municipal bond interest is exempt from income tax, it still gets added back in when the IRS calculates whether your Social Security benefit gets taxed. We'll walk through that calculation in a few minutes. But keep this in mind. Munis are excellent when your income sits comfortably above or comfortably below the Social Security thresholds with room to spare. If you're sitting right on one of those lines, loading up on munis can push you over it. Run the numbers before you commit a large sum. There's a related piece worth knowing that has nothing to do with the federal code at all: your state. A number of states don't tax retirement income the way the federal government does. Some exempt Social Security entirely at the state level. Others exclude a portion of pension or IRA income once you reach a certain age, and a handful have no state income tax whatsoever. None of this changes what the IRS does with your federal return, but it changes your total tax bill. It's well worth checking your own state's treatment of retirement income specifically, since it's rarely the same as how that state treats wages from a job. The next category surprises people because it doesn't feel like income at all, but it is, and the IRS agrees it isn't theirs. Category 3 is gifts and inheritances, and this is where people get the math wrong in a way that costs them real money. Under Internal Revenue Code Section 102, gifts and inheritances are excluded from the gross income of the recipient. If your adult children give you money, that money is not taxable income. If you inherit cash or assets from a parent or a sibling, that inheritance is not taxable income either. The IRS's authority simply doesn't reach those dollars on the receiving end. The annual gift exclusion threshold for 2026 is $19,000 per person per giver. A married couple with 2 adult children can receive up to $76,000 in a single calendar year in gifts with zero federal income tax owed by anyone receiving it. That's $76,000 completely outside the tax system. For inherited assets, there's a second layer. The cost basis steps up to the fair market value on the date of death. If your brother held a stock for 30 years that grew from $10 to $90 a share and left it to you, your basis becomes $90. You don't inherit 30 years of his taxable gain. It's erased. One important exception, and it's the one that trips families up the most: an inherited traditional IRA or 401k does not get this treatment. That money was never taxed going in, so the IRS collects when it comes out. Heirs generally have to empty an inherited traditional account within 10 years, paying ordinary income tax on every dollar, often during their own peak earning years when their tax rate is at its highest. Leaving $200,000 in a taxable brokerage account to your kids can mean they owe almost nothing after the step-up. Leaving that same $200,000 in a traditional IRA can mean handing a meaningful share of it straight to the IRS. The account you choose to pass down matters just as much as the amount. Take Patricia, a 67-year-old retired registered nurse in Savannah, Georgia. After her mother passed, she inherited $41,000 in cash from the estate and received a $19,000 gift from her 2 adult children in the same year, $60,000 arriving in a single calendar year. She owed zero federal income tax on any of it because under Section 102, It was excluded from her gross income entirely. Patricia didn't do anything unusual. She simply knew the rule. On the other end of the spectrum, consider a retired couple with a larger estate who want to move wealth to 3 grandchildren while they're still alive to see it used. Splitting the $19,000 annual exclusion between 2 givers and 3 recipients allows that couple to move $114,000 out of their estate in a single year, with no gift tax return required and no income tax owed by anyone on either side. Do that consistently over several years, and a meaningful portion of an estate can pass down completely outside the tax system simply by staying under a threshold that resets every January. Receiving gifts or inheritances doesn't affect your Social Security benefit calculation, and it doesn't count as provisional income for Social Security taxation purposes. For someone with a larger estate, a deliberate annual gifting strategy between family members can move significant sums across generations without triggering income tax at any level. One guardrail worth remembering, though: gifts are invisible to the IRS, but not to Medicaid. If long-term care might be in your future, Medicaid looks back 5 years at money you've given away, and large gifts can create a penalty there even though the IRS never blinks at them. The tax answer and the Medicaid answer are 2 separate questions. So, here's what I want you to do. The exemptions, the breaks, and the refunds most seniors already qualify for but never claim, I've put them all in one place, state by state, form by form, so you don't waste hours digging through government sites. Everything is laid out fast and simple so any senior can find exactly what applies to them. No matter what state you're in, there's money you're leaving on the table. It's called the Senior Exemption Playbook, and it's in the first pinned comment right below this video. Just tap it once, and you'll have everything you need. Now, stay right here, because the last category on this list is the biggest tax-free bucket most seniors don't even realize they already own. And it's the reason I made this whole video. We're not there yet, though. First, 2 more categories that trip up even careful planners. Category 4 is life insurance proceeds and policy loans. There are 2 distinct advantages here, though most people only know one of them. Death benefit proceeds paid to a beneficiary are income tax-free. That's the one people already know. The living strategy is the one almost nobody uses. If you hold a permanent life insurance policy with accumulated cash value, you can borrow against that cash value, and the loan is not taxable income. You're not withdrawing the money, you're borrowing against an asset. As long as the policy stays in force, the IRS has no claim on those loan proceeds. This becomes a genuine sequencing tool. In a year when an ordinary IRA withdrawal would push you into a higher taxation tier for Social Security or trigger a Medicare surcharge, a policy loan gives you access to cash without adding a single dollar to your modified adjusted gross income. Your taxable income stays below the threshold, your Social Security stays partially or fully protected, and your Medicare premium the following cycle gets calculated on a lower number. Medicare's income-related surcharges, called IRMAA, are recalculated based on your income from 2 years prior. That 2-year look-back is the entire mechanism. A high-income year today follows you into your premiums 2 years from now, whereas a well-sequenced income year today protects those future premiums. For a retiree already at the base Medicare premium level, protecting that level matters just as much as reducing a surcharge would for someone paying one. For someone with a higher income, IRMAA surcharges can add hundreds of dollars a month per person to Part B and Part D premiums. One poorly sequenced year creates 2 years of elevated bills. One caveat that responsible planning requires you to know: a policy loan isn't free money. Interest accrues on the balance, and if the loan plus interest ever grows larger than the policy's cash value, the policy can lapse. If it lapses with an outstanding loan, the amount above what you originally paid in can suddenly become taxable in one lump sum, alongside losing the death benefit altogether. This strategy works well when it's monitored, typically alongside the insurance carrier or a financial professional keeping an eye on the loan balance relative to the cash value. It's a genuinely useful tool, it just isn't a walk away and forget it one. Social Security taxation is where the most expensive misunderstandings happen, and the thresholds haven't moved since the 1980s. Pull up your most recent tax return, the actual document, not a summary, and find the line showing your provisional income. If you don't already know that number, this next part shows you exactly why it matters. Category 5 is the Social Security partial exclusion window. This is the section where everything before it connects. Up to 85% of your Social Security benefit can be included in taxable income, which means at minimum, 15% of your benefit is always tax-free at every income level. For lower income retirees, the exclusion is far larger than that. Provisional income is your adjusted gross income plus any tax-exempt interest plus half of your annual Social Security benefit. For a single filer, if that number is below $25,000, 0% of your Social Security is taxable. Between $25,000 and $34,000, up to 50% can be included. Above $34,000, up to 85% is included. For married couples filing jointly, the lower threshold is $32,000 and the upper threshold is $44,000. Those figures haven't been adjusted for inflation since Congress set them in the 1980s. A retiree earning the equivalent of $25,000 decades ago had a very different standard of living than someone earning $25,000 today. Inflation quietly pushed tens of millions of ordinary retirees past those thresholds without a single vote to tax them more heavily. It isn't a conspiracy, it's a structural feature of a law that was never indexed. Go back to the couple from the opening. If they draw their $80,000 carelessly, a large traditional IRA withdrawal, for instance, their provisional income climbs well above $44,000, and 85% of their Social Security benefit becomes taxable. That alone can pull another $15,000 to $20,000 into the tax system purely because of how the withdrawal was sequenced. Now, picture the same couple using everything covered so far. Roth distributions don't count toward provisional income. Municipal bond interest doesn't count toward it for this specific calculation, once you've already checked it against the trap I mentioned earlier. Policy loan proceeds don't count. Gifts received don't count. If they draw from Roth accounts and municipal bond interest first, stage traditional IRA withdrawals carefully, and lean on policy loans in higher income years, they can manage their provisional income to stay below the threshold entirely. 0% of their Social Security becomes taxable. Same $80,000, completely different outcome. That's sequencing. Even modest Social Security income combined with a small IRA withdrawal can cross the $25,000 threshold for a single filer who isn't watching closely. One unnecessary distribution can pull $8,000 to $12,000 of Social Security into taxable income that didn't need to be there. The gap between the 50% tier and the 85% tier isn't a small number over a 20-year retirement. At higher income levels, sequencing isn't optional. It's the difference between thousands of dollars staying with you or leaving every single year. Category 6 is one most retirees already have access to and haven't fully used. Health Savings Account, HSA, distributions for qualified medical expenses. The HSA is the only account in the federal tax code with 3 tax advantages stacked on top of each other. Contributions are deductible when you make them, growth inside the account is tax-free, and withdrawals used for qualified medical expenses are tax-free. No other account works this way. The mistake most retirees make is using the HSA immediately, paying current medical bills with HSA funds as they come in. That's a legal use of the account, but it's not the most powerful one. The IRS imposes no time limit on HSA reimbursements. You can pay a medical expense out of pocket today, keep the receipt, let the HSA continue growing tax-free for years, and reimburse yourself from the account a decade later. The reimbursement is still completely tax-free, and the money grew inside the account untaxed the entire time you waited. There's also a piece worth knowing once you're on Medicare. HSA funds can be used to pay your Medicare Part B, Part D, and Medicare Advantage premiums completely tax-free. That's a bill most retirees pay straight out of their Social Security check using money that's already been taxed once. Paying it from the HSA instead means covering it with money that was never taxed and never will be. Two boundaries are worth knowing before you rely on this one. First, to contribute to an HSA, you have to be enrolled in a qualifying high-deductible health plan. Once you enroll in Medicare, new contributions stop, though you can still spend whatever is already sitting in the account, and it keeps growing tax-free indefinitely. Second, anyone 55 or older can add a modest catch-up contribution on top of the standard annual limit, which is worth doing every single year you're still eligible, since every extra dollar in gets the same triple advantage as the rest of the account. Consider Diane, a 71-year-old retired pharmacist in Scottsdale, Arizona. She contributed to an HSA for 9 years before retiring and never touched the balance. She paid medical costs out of pocket the entire time and saved every receipt, totaling $23,000 in documented expenses over 9 years. In retirement, she reimbursed herself for the full $23,000 over 3 years, completely tax-free from an account that had grown substantially in the meantime. Diane didn't do anything unusual. She just knew the rule and kept the paperwork. For a lower-income retiree, the HSA reimbursement strategy creates a way to pull tax-free cash flow in a year when any additional taxable income would push Social Security into the taxable zone. For someone with a larger balance, the HSA turns into a dedicated medical reserve that generates no taxable income, no matter how large it grows. And that brings us to the final category. The one I told you at the start isn't an account you open anywhere. It's already sitting inside assets you already own. Category 7 is return of basis, or cost basis recovery. The concept is simple once you see it. When you invest after-tax money into a financial asset, that original contribution is your cost basis. You already paid income tax on it when you earned it. When you later withdraw or sell that asset, the portion representing your original basis isn't taxable income because the IRS already collected on that dollar once. It's not a strategy or a loophole. It's the mathematical structure of every after-tax investment you've ever made. This shows up in 3 common retirement situations. First, non-qualified annuities funded with after-tax money. Withdrawals come out in a specific order under the tax code, with gains distributed first and taxed. Once the gains are fully paid out, the remainder is your basis and it's tax-free. Most annuity holders never track this and assume every dollar coming out is taxable, but it isn't. Second, after-tax brokerage accounts. When you sell a security, only the gain above your cost basis is taxable. Buy shares for $40,000 and sell them for $55,000, and only $15,000 is taxable. The original $40,000 comes back to you untouched. Third, real estate. Your cost basis includes your original purchase price plus documented capital improvements, and only the gain above that combined basis is subject to capital gains tax. This category requires no account, no enrollment, and no form filed in advance. It only requires tracking numbers already attached to assets you own, and that's exactly why most retirees miss it. Old brokerage statements get lost, annuity contribution records go unfiled, and improvement receipts for a home bought decades ago disappear. When those assets eventually get sold, the entire amount looks like taxable gain because there's no documented basis to subtract from it. For a lower income retiree, recovering basis on a non-qualified annuity or a brokerage account can reduce or eliminate the taxable portion of the withdrawals you depend on. For someone with significant after-tax investment accounts, the basis represents potentially tens of thousands of dollars the IRS legally cannot touch. The only question is whether you can prove it. Gerald is a retired contractor in Memphis, Tennessee, who sold a rental property he'd owned for 22 years. The sale price was $310,000. His original purchase price was $95,000, and his documented capital improvements over the years totaled $47,000, putting his actual cost basis at $142,000. His taxable gain was $168,000, not $215,000. The difference, $47,000, is money the IRS had no legal claim on because Gerald kept every contractor invoice and permit for 22 years in a single accordion folder. You were probably convinced this last category didn't apply to you, but it does. Every financial asset you own that was funded with after-tax dollars carries a cost basis, and that basis is a number the IRS cannot reach. The only question is whether you actually know what it is. Return to where this started, a retired couple bringing in $80,000 a year owing tax on almost none of it. That's not luck, and it isn't a loophole. It's 7 categories written directly into the federal tax code that your bank, your broker, and the IRS itself have no obligation to walk you through. Roth distributions timed deliberately. Municipal bond interest used carefully around Social Security thresholds. Gifts and inheritances excluded from gross income under Section 102. Life insurance policy loans used as a sequencing tool to protect Medicare premiums. Social Security benefits managed against thresholds frozen since the 1980s. HSA reimbursements drawn years after the original expense. Cost basis recovered from after-tax assets the IRS already taxed once. None of these work in isolation, as well as they work together. The sequencing is the real strategy. Each category becomes more powerful when it's deployed at the right moment relative to the others. Here's your action checklist. Identify every account you hold and classify it. Traditional IRA, Roth IRA, after-tax brokerage, HSA, annuity, or taxable savings. Locate your cost basis documentation for every after-tax account, annuity, and property you own. If you can't find it, request it from your brokerage or insurance company in writing. Calculate your provisional income using last year's tax return, adjusted gross income plus tax-exempt interest plus half your Social Security benefit, and compare it to the $25,000 threshold if you're single or $32,000 if you're married. If you're above either line, you have a sequencing problem worth solving. Pull your Medicare premium notice and check whether you're paying an IRMAA surcharge. If you are, trace it back to your income from 2 years earlier and find the withdrawal that caused it, so you know which type of income to replace with a tax-free source going forward. If you're charitably inclined and past the age where RMDs apply, look into routing next year's donation through a qualified charitable distribution instead of writing a check after the fact. Start a folder, physical or digital, for HSA receipts and capital improvement records, because every qualified medical expense you pay out of pocket from now on becomes a future tax-free reimbursement, and every documented upgrade to a property reduces the taxable gain when it's eventually sold. Check whether your state taxes retirement income differently than the federal government does, since that's a separate calculation entirely and easy to overlook. Finally, map out the order you'll draw from your accounts next year against the Social Security thresholds. Roth and Muni income first, traditional IRA distributions last, and only up to the amount needed to stay below the tier that increases your taxation. None of these 7 categories require special access, a minimum net worth, or a connection anyone else doesn't have. They're published, public, and available to anyone willing to read the fine print most people never get handed. None of it requires you to do anything complicated all at once either. Most retirees who use this well didn't overhaul their finances in a single afternoon. They picked one category, fixed it, and moved to the next one the following year. The IRS was never going to hand you this list. Now you have it.